Hello and welcome to this week's webinar, the Market Outlook with me, David Jones and Ayondo. If you're watching the recorded version of this, it was held live on Wednesday, May the 17th at 12:30 in the afternoon. So this is a webinar I do every week on a Wednesday lunchtime, and there's a few parts to it, a couple of parts to it. We take a look at what's been going on in the markets over the last few days, what to look out for. There's been some moves overnight in US stock markets. Finally, a bit of volatility in the out-of-hours market. So it'll be an interesting day in the US today. We'll take a look at that. So we'll have a look at a mix of currencies, indices, commodities, and also we'll spend a bit of time talking about strategy. Let me just, is that working? Yeah, that should be working, shouldn't it? There we go. I'm just making sure that it's all working. Okay. So hopefully you've got the risk warning on your screen there, explaining the risks of spread betting in CFDs because they're leveraged products. But let's take a look now at the trading platform just to see what's been going on. So as usual, what I'm using, this is Ayondo's Trade Hub platform. So Ayondo are well known, probably maybe better known for social trading, where you can copy other traders, and I do a regular webinar with them once a month. But you can also trade for yourself. Of course, you can also log on and buy, sell on your own. You don't need to be following other people. So let's start off by looking at, I think the euro is one to take a look at. Let's just maximize this because we have seen, we were talking about this last week. If you remember, the level we were looking at last week on the euro, we've got to zoom all the way back here. Here we go. So it had been after the various surges off the back of the French general election, the sort of the first stage and the second stage. We'd seen some euro surges and a lot of sidewaysy stuff going on. So this time last week we'd have been here May the 10th, and going back to my old favourites, the support and resistance, so we've got clear levels to keep an eye on, 108.20 to 108.50. So we were looking at it sort of back here, expecting these levels to hold and for the market to bounce. But if they broke, it does suggest quite a shift in sentiment. We did get a bit of a wobble lower the next day, so it pushed a little bit lower last Thursday, probing that sort of first level of support. But the support held, and the market, I didn't think it was going to move this much, but the market has rallied, what's that, something like 250 points off that level, showing that the old principle of support and resistance, low risk, potentially high reward, plays out again. But let's take a look at where this leaves us on the dailies for the euro. So there we go. This is what the longer term chart looks like for the euro. The obvious objective, I think, and we're virtually there. Maybe these old highs from November last year, around about 111.50, that sort of zone. The trend for this year definitely still intact. You could argue, and I wouldn't argue against you, that it's maybe looking a bit overextended at the moment. I wouldn't necessarily, or I wouldn't want to be going short, but I think if we did get something of a pullback from these somewhat elevated levels, it does look like a buying opportunity. Let's put our old squiggly lines on the bottom of the RSI, because I'm guessing we're going to be looking, pretty overextended there. We've actually got very good bearish divergence that's stacked up here. So where the market's pushed to a high and pushed higher still, but the RSI is making lower highs. So this could be a suggestion that we're getting, the exhaustion top is in place. If you were going to trade off that, it's not one I would do, but the trade would be go short now, wherever it is, 111.03, with a stop loss above that recent high. If this RSI divergence is going to play out, then the top is in, and we are due something of a correction. But I suggest the more textbook trade here is wait to see if we get a sell-off, wait for it to find support, and then buy in again, looking for another run-up to these levels. But I think however you cut it at the moment, that's a bullish move by euro dollar out to its best levels in something like 6 months, maybe a little bit overextended, due a bit of a pullback, but still be looking to be a buyer on the dips. You'll see I've got a moving average on there. Let's talk a bit about moving averages. That's our strategy thing for today. And I must admit, I don't look at them myself. But saying that, I think they do have their uses. They can maybe, at the very least, reinforce which way the trend is. So that the principle behind moving averages, this one is a simple moving average, SMA. And personally, that if I'm going to look at a moving average, I just use the simple one. So we've got a 20-day SMA, you can see up there, top left. So at the moment, it's trading just around, where is it? So the 20-day moving average is around 109.38. So what that tells us, it's a very simple calculation. This is a daily chart we're looking at. It looks at the last 20 days closing prices, divides it by 20, and then we end up with a value for today. So that's the average price of the last 20 days. And of course, tomorrow it does the calculation again, and so it goes on. You know, and it's a moving average because, of course, it will move as the market moves up or down. But the basic principle behind moving averages is this: it's a trend following system. So it works very well when markets are trending. It doesn't work very well at all if markets are choppy and sideways. But you may have heard the term moving average crossover, and this is what it is. In its most simplest format, it's a crossover system. So if we walk back to here, so November last year, so the euro dollar was sliding, the moving average was above the euro dollar because it's taking into account higher prices. So the moving average is going to have a higher value than the market. But when the market crosses up through the moving average, that's our buy signal. Okay, so the market's moved above the moving average. The assumption is if we're using this simple moving average crossover, that the market could be starting a new trend higher. And then here, when the market flips below the moving average, that's our sell signal. Okay, so if it falls below the moving average, the assumption is we're going to start into a downtrend. And of course, depending on what length moving average you use, we get various signals. This is a 20-day moving average, so 20 days is a trading month. But it still gets chopped around. This is the drawback with moving averages. If you're following a moving average system blindly, this bit here from September through to October last year illustrates the pitfalls. Because the market isn't really going anywhere, the price and the moving average are very close together. So you have buy, sell, buy, sell, buy, sell, buy, sell, buy, sell, until you finally get a good signal there. But by that time, you're probably really frustrated with it and you miss the signal. So I think this is, I'd never follow them blindly, but maybe as a way of just confirming to yourself what the trend is, maybe that's the use. But you can see when you do get a big trending move, like here, from the 9th of November, where the moving average, if you'd have taken the signal as it crossed, the moving average was short from 109.80 and then stayed short to 106.60. So caught a 320-point move. When you get these good trends, that's when it does pretty well. And it's not done too bad. The swings we've had this year, because they've been quite decent sized swings, you know, the moving average has probably caught, you know, a reasonable chunk of those profits. There hasn't really been much sideways stuff going on. So the last couple of signals we had back here, 18th of April, moving average, the 20-day moving average signaled a buy on a move through 106.80. It closed it and went short, or about 108.70, so made, again, nearly a couple of hundred points there. It got stopped out of that short here, though, and it went long into this move at around about just below 109, and the market's currently 111. So if you get the half-decent swings, you know, moving averages don't do a bad job, but just be very aware of the chop that happens when the market goes sideways. Now, if I flick this over to an hourly chart, the moving average is still on it, but of course, because what we're looking at now are hourly candles, it's now a 20-hour moving average. So it's not a 20-day, it's a 20-hour moving average. So you'll get a lot more signals, of course, and a lot more false signals. You can just see when we had in this period beginning the month where euro dollar was broadly sideways, we were getting sort of chopped buy sell signals every 10-15 hours or so. When you get a good trend, like from here, from what's that, beginning of last week, the market, you know, it did well to catch that trend, but then there's a bit of a chop as the market consolidates, and it's currently, what's it done currently? It gave a sell signal there. It's currently long. So based off the 20-hour moving average, it went long a couple of hours ago when the market, let me just zoom in, crossed above the there, the moving average there, about 10 o'clock this morning. So that's you know, an indication of how it gets used. There are various other things you can do. You can use two moving averages together to try and filter out the signals, but for today, let's keep it easy and let's just stick with our single moving average. So euro dollar, just to recap, you know, a big move off those levels we were talking about last week. Maybe looking a little bit overstretched here, also looking quite overstretched on the daily chart according to the RSI, so maybe due something of a sell-off for these levels, but that trend is most definitely up. You know, if we plonk our trend line in off the lows, the January lows, 3rd of Jan, to wherever we are now, you know, there's our trend in euro dollar. So it could, for the daily charts, it could weather quite a big sell-off here. For short-term traders, I'd be looking at maybe the hourly charts and looking to see if it does start to sell off, where do we find support for euro dollar. Right, that's that one done. Let's take a look at something else. Again, this is a bit of a long-term one, but I think this is a really interesting one to watch over the next few days. This is New Zealand dollar, US dollar. Let's just wind this out. This is an old favorite. We started looking at this during the summer, and the market has traded sideways and a bit weaker since then. But on the subject of trends, let's just take a look at the trend on New Zealand dollar, US dollar. There we go. It looks something like that. So we have had this trend that's been in place since September 2015. So we're 18 months into this uptrend in New Zealand dollar, US dollar, and the weakness that we've seen has brought it back to the trend line. So if the market was going to bounce from anywhere, then we're here. So it's a really interesting one for New Zealand dollar, US dollar. Let's just zoom in and take a look at what's going on. We also have the thing we've talked about in the past, this idea of RSI divergence, where the market is pushed to a low and then it's pushed lower still. The RSI is making higher lows. So, I mean, I think the aggressive trade here for a sort of medium-term trade on New Zealand dollar, US dollar, would be to be a buyer now, wherever it is, 68.90. Excuse me, and put a stop loss maybe under this low, sort of just beyond 6,800. Perhaps the more patient trade is to watch it on the hourly chart and see what it looks like, because if we zoom that out, we do have, I suppose it depends on where you draw your trend line. It's got a bit messy over the last week or so. Let me see what it looks like on a 4-hour chart. Okay, we haven't got it. Okay, on hours. Because you could argue that the correction, the downtrend correction-y bit from up here is still intact. Is that still intact? Yeah, just about. So maybe we want to be a bit more patient. But I think New Zealand dollar on the medium-term chart is an interesting one to watch, because we do have that trend that's been in place. We'll do one more currency, then we'll look at stock markets and then gold, and also another market we haven't looked at before. We're going to look at T-bonds, but we'll do dollar yen. I was talking about this a couple of weeks ago, and I was expecting it to run out of steam. I was expecting the trend, the sort of little bounce back to stall, but it didn't. It's pushed a little bit higher, well, it pushed quite a bit higher. But I'm wondering if now it has finally stalled. So first of all, let's start off with the daily chart on dollar yen. So we had a downtrend that had been in place for much of this year. Let's just plonk our line on the dollar yen chart. There we go. And I think I was looking at it back here, maybe so a couple of weeks ago on the webinar, expecting the downtrend to resume, bang, and the market to sell off. It didn't. It pushed higher, but it did stall, or it has stalled so far, ahead of what has been a big problem for dollar yen in the past. So the 115 level, it looks like it got as high as sort of 114.30. So it does look, if we flip it over to the hourlies, you know, that's what's happened over the last week or so. So we have seen the market finally run out of steam, and I think it's always a problem when we have a move so quick like this, because for me, if I wanted to be short, my short probably for me still needs to go above these highs up there. So whilst I think on the daily charts it does look like dollar yen has rolled over, the better entry for me would be if we got a rally back up and then a run out of steam again. So a better entry point. And you could argue there's a reasonable chance of a rally. We've got good support at sort of ahead of the 112 level down here. We're currently about 30, 35 points above that. So for me, if we did get a bit of a squeeze back up, sort of looking at 114, and then the market running out of steam, it's maybe a better entry to go short. But let's see. I think finally it looks like it's rolled over. Let's talk about stock markets. Stock markets. Let's talk about the US first of all. I think that's the major one. And we'll look at the S&P, and we'll look at the Dow, and then we'll look at the European markets. It's been really interesting. I think the moves that we've seen over the last few days. Saying that, it's been the lowest volatility up to the close yesterday. It's the biggest run of lowest volatility days in the S&P 500 for 48 years. I think we'd had 17 days where the in-hours trade on the S&P index was 0.5% or lower, and we've not had that sort of run for nearly 50 years. I think I retweeted something last night, and I think it may be wrong-footed a few people, because we did have, there we go, hang on, where's it gone? So we did have the market sort of moved out to fresh all-time highs very briefly, May the 7th, and also yesterday during the session started off at all-time highs, then reversed. So we did see the markets pushed up, but there's been no real follow-through. So it's been a really, I think, quite frustrating. You know, if you were trading the breakouts, it's been quite a frustrating one. But the interesting thing is, I think, is the move we've seen overnight. So going into today, so we've got just over an hour and a half until trading officially starts. I think it's going to be a really interesting session today. So let me just take this out. This is the hourly chart now of the S&P. And if we sort of plonk our lines on, I think I've managed to mess these lines up somehow. Oh, God, it's not in the right place. Let's draw that again. Horizontal high low. So we want to put it off these lows. Interestingly, if you are a chart geek like me, the sell-off that we've had overnight, which I'm assuming is to do what's going on with some of the stuff coming out of the Trump administration, we've seen a really big sell-off overnight, but it has held above these May lows, so 23.78 on the S&P. It looks like it's traded down to 23.80 overnight. It's bounced off these levels, but we're still a lot lower than where we closed last night on the S&P, good sort of 10, 12 points lower. So I think it's going to be an interesting session today because the market has been very quiet. We've had this burst of volatility that's going to come back in. So how are traders and investors going to react? And for my money, famous last words, I think we might, if we start here, I think there's a reasonable chance the market will sell off initially. And I think that's going to be the interesting thing to watch. How does it perform in this area here, sort of 78 to 82? So for me, if one trade is, if we pull back towards that 82 sort of area, you'd want to be a buyer from a technical point of view with a stop under those lows. If these lows break this week, that is going to be interesting, I think, because that could convince maybe enough people that for now this strength that we've seen is running out of steam. So I think that's going to be an interesting one to watch this afternoon. Of course, if the market just ramps its way back up to 2400, we're back to where we were yesterday, and we've maybe got a somewhat frustrating market. But I think it will be much more interesting if we see a sell-off on the open today and how it performs with, first of all, those overnight highs and these highs that have held, these lows, sorry, that have held the market up all the way through May. So that's the S&P 500. Let's take a look at the Dow, because it's odd, because even though the S&P has moved out to fresh all-time highs, I don't think we've seen it on the Dow. The Dow hasn't quite managed to do it. So let's just flip this out to a daily. There we go. So we saw the highs on the Dow back on the 1st of March, and it's not quite managed to do it, even though the S&P's nudged sort of up to there. The Dow has remained somewhat resolutely trapped below those levels. So again, going over to the hourlies, we've had that weakness overnight. So we've had a sell-off in the overnight market. It's brought us back to, it's not as clearly defined a level on the Dow, but for those of you, who are trading the Dow, then again, the big zone to watch this afternoon, that old low from May the 11th, so that's what, last Thursday, 27.90-ish. The overnight lows at 28.25. The market's currently 28.70. So we are less than 100 points above that low from last week. So again, I think it's going to be an interesting session this afternoon. if we see US markets sell off and how they perform if they do get back to these sort of levels. But we have been in an incredibly low volatility environment, but that has kicked off overnight. So I think we could have, hopefully, an interesting couple of days in the US. Saying all of this, it doesn't change those overall big trends, of course. You know, it was only yesterday, I think, or the day before, where the S&P 500 pushed out to fresh all-time highs. So these are markets that, in the medium term, you know, are still strong. But I think it'd be interesting to see how they perform in the short term. Let's take a look at gold. Before we look at gold, let's take a look at T-bonds. This is the US Treasury bond. It's a widely traded market in the real market, but it's maybe not a popular one in my experience with investors. But I think it's always, you know, an interesting market to watch because it's, you know, it's the classic, one of the classic safe destinations, safe haven destinations for investors, and it's I think it's because it does see high volume in the real underlying market. I think it's quite a good technical market. I've done about 4 or 5 trades on T-bonds this month. I've got one on at the moment, and I'm a big fan of it as a sort of a relatively calmish market to trade. But let's take a look. This is the June contract, and we had been in this downtrend, and you can see just how well that downtrend had performed since, was that the middle of April the 19th. But in recent days, T-bonds, US Treasuries, have broken out of that downtrend and pushed, because again of this overnight shenanigans, pushed out to their best levels for just over a week or so. So for me, on T-bond, I'm long at the moment. I'm long from the messy bit in here, and I've moved my stop up. But for me, you know, the fact it's broken out of that trend, broken some important highs, suggests it's sort of flipped from selling the rallies to buying the dips. So for me, that's going to be an interesting market to watch. And typically, or usually, it will move inverse to the stock market. You know, if the stock market's going up, we'll typically see T-bonds drop. If the stock market starts dropping, people look for a safe destination, and we'll see T-bonds, US Treasuries going up. So I think it's if it's one you've never looked at before, it's maybe a bit less volatile than certain currency markets can be. It's a widely traded market. I think it's one worth one worth keeping an eye on. So questions come in. How do you mentally deal when a trade goes against you, but you still believe in your stop? I've ended up increasing the stop and lost. Right, you shouldn't do that then. But you really shouldn't do that. If when you put a trade on, you should, so let's stick with T-bonds, right? So for me, the trade this afternoon, let's say that T-bonds sold off a bit and sold off to 150, 150. So they're currently, what are they, 152.14. So they dropped about 60, 70 points this afternoon, but showed a bit of stability at 150, 150. Now, if I was a buyer there, and I'd quite happily be a buyer there, I'd want my stop the other side of that low, which is the low from yesterday. And, you know, so my stop might go at 150.70. Now, then it's a hands-off. You take your hands off, you know, because if the market starts moving down to your stop, it's completely the wrong thing. But it's a common enough mistake. I will try and take the sarcasm out of my voice. It is a common enough mistake to move your stop loss because you want to stay in the trade. Yeah, but I would say you should never do that. You know, when you first set a stop loss, and it's an important process to go through. If I'm going to buy this thing here, and my stop loss goes there, if I get stopped out, do I still think that's the right place to have a stop loss? And I think the mistake people make is they set their stop losses too tight, which can lead to them moving the stop loss if the market gets towards it. So for me, I think, you know, it's the most important thing to think about when you first put the trade on, in addition to how big do you trade. Where's your stop loss going to go? So for me, it goes at a level where, right, if that level breaks, I need to rethink my whole outlook on this market. And I think it's a good thing to get out. Taking a loss is always a pain, of course, but it's a good thing to get out and then look at it at a fresh pair of eyes. I think if you're moving your stop loss away and you're racking up bigger and bigger losses, you can't look at the market objectively. So yeah, so don't set your stop losses, for me, looking on an hourly chart. Don't just set them randomly in the middle somewhere. You know, I want to set them beyond an extreme. And this was a big level. This was May the 16th. That was yesterday's low, which did just punch through very briefly through the day before's low. So this whole 151 to 150.90 area is a big zone. We've seen buying there the last couple of days. So I'd suggest putting it in a putting it, if you're doing a trade, set it beyond these obvious areas. But no, you slap yourself on the wrist if you start moving your stop losses. Can we follow your trades on Aondo? No, I don't trade on Aondo. Most of the trade, I follow other traders on Aondo, and I've blogged about that. I think I set an account up 3 months ago, and it's up about 5% so far. But no, I don't. Because a lot of the stuff I do is options. So I've got options on the S&P at the moment that expire on Friday. So maybe if I get more active with stuff like this on T-bonds, I should do more, and I'll make sure that you know. But I don't do that. So there's that. I think US T-bonds. I think there it is on the platform there. The June T-bond. It's an interesting one to watch. I think given the moves we've seen in stock markets overnight. Now the last one we're going to look at, gold. This has been another old favourite over sort of recent months, and my view on gold is still we should see further gains for gold this year. Let's just remind ourselves where we are on the daily. So the reason is we had this trend that we've seen in place for much of this year on the price of gold, look like that. And then last week when I was talking about it, we were saying, well, let's see what happens. Do we get the bounce off the trend line? All right, we didn't get the bounce off the trend line. The market did slip a little bit lower, well actually quite a bit lower, another $20 lower, but we do have this big old support down here. And combining a couple of things, we've seen, I think I talked about this last time around, we had, last time the price of gold slid off, the RSI did a pretty good job in calling the tone, and it has worked again this time around, where the market, it went oversold for a few days and it's bounced back. And also going back to the moving average thing we were talking about earlier, we got a moving average signal just yesterday, it looks like, at the close, where the price moved above the moving average, and you can see it's done again a pretty good job of catching the swings up. So that to me adds to the argument at the moment that maybe the path of least resistance for gold over the next few days is going to be up. But let's take a look on the hourlies. Great trend. Look at that trend on the hourlies. They're always easy to spot in hindsight, aren't they? But for a week now, we've seen that market just trending higher. And it was another trend line break, depending on where you draw it from. I'd probably be inclined to draw it from this one when it really sort of started accelerating lower afterwards. So looking something like that. There we go. So we broke out of that. Let's drag that across and let's plonk a line on the doodah, on the uptrend. There we go. So we've got a lovely little trend chugging high in the price of gold. For me, my target would be a run back up to these old highs. Let's say, so 1300 would be my target. As ever, the question is, if we're going to buy it, where do we put our stop loss? I would suggest, for me, the closest I'd want it would be the other side of the lows from a couple of days ago. But it's really strong. It's looking maybe a little bit overcooked. But I think, based on the moves in the dailies, we have seen, for me, that correction is over. If it drifts back to here, it's another buying opportunity with a stop loss under that low. But I think for me, even though it's slipped out of the trend line, we've still got higher lows and, of course, higher highs. And yesterday, for the moving average fans, it flipped over that 20-day moving average. So I think gold's an interesting one to keep an eye on. So to recap, what's worth watching? I think, well, Euro dollar, because it's run up so far, it's maybe looking a little bit overcooked up at current levels, but any sell-off looks to be a buying opportunity. That New Zealand dollar, again, because of the big picture trend, is still up. Let's see what happens. There's the 68 level hold. The immediate ones, I think that maybe the fun and games markets to watch this afternoon are going to be these US stock indices. Okay, we've seen them fall off a cliff overnight, big burst of volatility. How is it going to perform near these May lows? T-bonds, treasuries, US treasuries, in conjunction with that, if stock markets continue to sell off, we'd expect to see further strength here. And a maybe more relaxed market is the price of gold, because the trend for this year is up. It looks like it has sort of turned the corner, and that's it really. That's still T-bonds. Another question: what's a good number of pairs to follow? 20 too many? I say I think so. I mean, for me personally, I do end up watching too many markets, and I think it can be quite tiring. You end up not seeing the wood for the trees, and there's maybe the temptation to try and trade everything. So for me, I've definitely this year just focused on a handful. The stuff I look at every day is the S&P 500, the US stock market, because I've normally got a trade on, but also T-bonds and maybe a major currency like euro dollar, pound against the dollar, something like that. So I couldn't follow 20 personally. I'd struggle trying to follow that many markets. Let's wrap things up. And there's normally, opportunities. I think there's normally, if you're a day trader, there's normally at least one trade a day. I think in just a US index. If you're a medium-term trader, there probably isn't. We'll wrap things up there. If you have any questions, drop me an email. David@tradeafter.com. I think I updated my blog page a couple of days ago with the latest results of this copy trader experiment where I put £2,000 in an account and I added a new trader. So you can read about that on tradeafter.com, and you can follow me for charts and stuff on Twitter. And on Twitter, I'm at Jones the Markets. But it's 1 o'clock, almost on the dot. So we'll wrap things up there. I think some interesting stuff to watch the next couple of days, particularly US stock markets. But we'll do this all again next Wednesday. I hope you have a good week, and I hope you can make it next time round. But for now, we'll just close the webinar down.